So I think taxable and tax-exempt bonds are actually pretty interesting offensively. Defensively, we still really like top of the capital structure, structured credit. So things like commercial mortgage-backed securities, double single A bonds, very short single double A CLOs, collateralized loan obligations, and some short bank bonds as well.
All right, welcome back inside our proactive newsroom. And joining me now is Sean Dranfield. He is the CEO of PT Asset Management. And Sean, it's great to see you again. How are you?
Steve, I'm really well. Thanks a lot for having me again.
Yeah, good to have you along as we talk about the Performance Trust Total Return Bond ETF. And let's start with rates, Sean, and talk to me a little bit about are you seeing big fluctuations in rates right now as far as the bond market is concerned?
Yeah, and so it's been an interesting year, Steve. So, we started the year at, rates, at the, 10-year part of the curve, maybe 50, 60 basis points less than they were today. The long end of the curve rates are up a little, short end of the curve rates are up a lot, right? So we've had like this flattening in the yield curve year to date. And rates are entirely unpredictable, right? So if you think about like the Fed, like Warsh, as you recall, when he was being, he was lobbying to be nominated as the Fed chair, he, was trying to push for rates going down. And of course, now we've got more inflationary pressure because of oil, and now he's talking about rates going up. So he can't predict rates, nor can we. But we've had this flattening in the yield curve. And what does that mean? It means there's more opportunity really at the short end of the curve that provides sort of opportunities for bonds that provide solid returns with very little interest rate sensitivity. So we've definitely had a bit of a flattening in the curve year to date. And it's largely driven by fears around sort of inflation.
Yeah, and the challenge is that it may get better for a couple of weeks, and then something happens and brings it back, and it's sort of that seesawing of back and forth, back and forth. And I guess what people want to see is more of a flatter curve. Maybe is that a best way to describe it?
Yeah, I think what people want to see is some stability, right?
Yeah.
So I think to your point, like we've had this, what's going to happen, and it's really largely around Iran and the Strait of Hormuz and the impact on inflation. And the market's just looking for some clarity there, right? And as we've experienced year to date, there really isn't any. There's a desire to create some stability, but you never know if that's going to happen or not. So rates have definitely priced in, a rates up move at the short end of the curve because there certainly is some inflationary pressure overall, and particularly driven by oil, despite the fact that the oil price has come down pretty significantly, right, from its highs, but it's still higher than it was.
Yeah. Does that affect the spread environment then? Are you seeing some wild fluctuations there as well?
Yeah, so we saw spreads widen a fair bit sort of, when the Iran war sort of begun to happen, but, frankly, they're back down to levels that they were at the beginning of the year. And what's interesting about those levels is spreads, particularly for corporate bonds, are at close to all-time historic tights. So there's not a lot of, juice in the squeeze, as it were, from taking on credit risk in the corporate bond market. So when that's the case, when spreads are really tight, so there's no extra yield delivered by spreads, you want to buy shorter bonds because if spreads widen on a longer bond, the price is going to go down more than it would if you were buying a shorter bond. And there are some spread opportunities outside of the corporate world, though, that I think are pretty interesting. But spreads generally are pretty tight.
Okay. You mentioned opportunities. Let's talk about that part of it because when you have an environment like this, there is opportunity for people, both positive and negative.
Yeah, so the way we think about opportunities is we're entirely rate agnostic. Like we don't believe anybody, including us, can predict rates. So we're always trying to balance what I would call offense, which is bonds that will help you if rates go down, with defense, bonds that'll help you if rates go up, and trying to create this more balanced, steady Eddie sort of outcome, right? So on the offensive side today, we really like both taxable and tax exempt municipal bonds in the US. So I know it's a US centric sort of phenomena, this municipal bond market, but it's a really large market, right? And so taxable bonds that are sort of longer bonds have pretty exciting yields, and spreads aren't as tight as they are in corporate bonds. And then tax exempt bonds are actually even more attractive to a tax exempt investor because you've got really high yields and you've got a really steep yield curve. And what that means is when the yield curve is steep, a bond will roll down the curve. And as we know, when yields go down, the price of a bond goes up. So I think taxable and tax exempt bonds are actually pretty interesting offensively. Defensively, we still really like top of the capital structure, structured credit. So things like commercial mortgage-backed securities, double single A bonds, very short single double A CLOs, collateralized loan obligations, and some short bank bonds as well. So we like short bonds. And the cool thing about those bonds is you're getting yields anywhere from 5.5 to sort of upwards of 7 in some cases. And these are bonds that don't have a lot of credit risk and they aren't interest rate insensitive. So it's a really nice hunting ground defensively now. And when you pair those with the offensive bonds, you get this more of this sort of rate agnostic outcome over time.
Sean, is it an environment for risk friendly or risk adverse? Or is there an opportunity for both of those type of people?
Yeah, I would say what's cool is you can buy, if you're a risk averse investor, you can now buy bonds that have 5 to 7% yields, right? And you're buying double and triple A bonds, so fairly risk averse bonds. And I know that's not like the long-term return of the equity market, but for a bond investor, if you can get a really nice single digit return while taking not a lot of credit risk and not a lot of interest rate risk, that's a pretty attractive environment. And bonds typically are negatively correlated to equities, not all the time. 2022 is obviously an anomaly there, but
Yeah.
generally speaking, negatively correlated. So, if you're looking at yields around 6%, that's a pretty nice counterweight to equities in this sort of environment. And you can do it without taking a ton of credit or interest rate risk.
As always, Sean, great insight. Love talking to you. Thank you so much, my friend. Good to see you again, and we'll talk soon, okay?
Many thanks, Steve. Take care. Thank you.
All right, good stuff.
Bye.
Sean Dranfield, the CEO of PT Asset Management.